Good morning to all of our attendees and welcome to the overview of the post-budget 2025. My name is Nico Boyson. I'm the Chief Operating Officer of CBS Audit Tax and Advisory. Certainly a very interesting budget season, 2025, Government of National Unity. A few interesting ideas, fiscal policy, per capita considerations, educational issues that obviously came up in the budget as well, government expenditure, solvency and growth issues, and of course, a direct and indirect expenditure of 10 billion on the NHI. And then the key one, the economic growth and the debt to GDP ratio. We'd like to welcome you this morning. Thank you for taking the time to join us. I'm now going to hand over to the esteemed Mr. Mohammed Mayet, who will guide us through the overview of the post-budget 2025. Mohammed, thank you very much.
Hi, good morning. Thank you very much, Mr. Boyson, and good morning to all our listeners. Thank you very much for the CBS Group to allow me the opportunity to present the post-budget presentation. Indeed, Mr. Boyson, I think you make an important point. It's the first very interesting budget in our democracy in the last 30 years. The GNU has brought its very special dynamics in its say. And, we've seen that playing out yesterday with regards to, the presentation of the budget itself, as well as, the matters of contention coming up. Let me then take this opportunity to obviously kind of, give you a summary and a high level overview of, what I see happening this year and, unpacking that for everybody today. So, let's go. Let's have a look. We start off firstly with the budget and tax policy announcements. And just to perhaps maybe kick off, the macroeconomic overview, ladies and gentlemen, as you can see, during the last fiscal year, March 2024 to Feb 2025, we've seen just about, the rand dollar as the common denominator for the international exchange rate, sitting at about 18 rand 1 cent. So, South Africa has gone through this kind of patch of around the 17, 18 mark. And you see at the end of February that 18 rand still staying there. Naturally, the dynamics come in with the new Trump administration, and one would then need to see whether, all the proposed changes coming out of the US, how that will affect the South African domestic market, and whether, we see any positives or negatives impacting on the rand dollar into this financial year as we go ahead. Coming out of the budget, you see the minister announced a proposed they're expecting a domestic growth of 1.8%, very, very bold for the South African economy, given the context of the unemployment rate, the SRD grant that's continuation till March or February 2026. So, the 1.8% in my view is very, very high expectation. And one also looks at 2024, government has achieved only 0.6% in growth. So this is almost double for the next year. And given the current challenges we face, it's going to be a momentum to climb and get to this. Global growth, expectations from the World Bank and International Monetary Fund predicting for 2025 in both emerging markets and matured markets at 3.3%. Again, here, my view is obviously with the big elephant in the room being the United States and the changes that are coming in not every month, but every day from the Trump administration, that 3.3% also will need to be seen how that goes along. From the budget that has been presented yesterday, where is your money being spent? Let's have a look. So I think, the minister has pointed out key priorities in terms of where the money will go. We see kind of 8 to 9 sections of key areas where, the money will be spent. Education and culture, 500 some billion. Health, 299 billion. Naturally, the NHI is a big talking point and how that will be funded. Social development, 422 billion. community development almost 280, economic development at 289, safety and security at 256, public administration at 70, and this is the first time I see this coming out of this budget, a contingency reserve of almost 50 billion. Perhaps maybe the contingency reserve is unexpected events that occur during the next year that nobody knows about, or perhaps maybe it's something else to cater for certain expenditures, and that's a contingency fund. So this particular pie chart displays where the key areas of the expenditure will go into 2025, 2026. The tax changes and policy announcements, let's have a look where there's been no changes to the general tax-paying public and, kind of giving you some certainty as to, business as usual as far as tax items are concerned. Corporate income tax stays the same at 27%. Dividend tax stays at 20%. Trusts at 45%. Donation tax at 20%. The estate duty is, you're also familiar with, between 1 and 30 million stays at 20%. Anything above 30 million rand attracts the 25%. As far as capital gains tax is concerned, also a big concern and talking point, and wanted to see whether the minister was actually going to touch into this pot and perhaps maybe increase this this tax on different sectors. But that also remained the same. Individuals at 18% net effective rate, on businesses 21.6%, and on trust at 36%. We go on to the indirect taxes. As you are all aware, the VAT threshold for businesses conducting turnover of R1 million and above, that still remains the same. There's no changes there. Interest exemption below 65, also no changes there, 23,800. Interest exemption for above 65 is at 34,500. Here, I've just had a look at the personal income tax tables affecting you and I and the broader South African tax public on an individual basis. You will see that personal income tax between R1 and 237,100 attracts 18%, also not changed. The middle income earners at 512,000 to 673,000 at 36%. And personal income tax in the high income earners attracts the 45%, no changes there. We continue again with the amendments that have come through. Naturally, we're all aware with the big talking point and the delay of the budget from last month to this month. Obviously, government's had a rethink. The GNU has had cabinet meetings after cabinet meetings non-stop, so much so even yesterday up till 12 o'clock midday, the cabinet was still stuck in debating whether any increases will take place, whether those increases are in fact warranted or not. And eventually no agreement was reached. No agreement was reached
yes, I'm just busy in
by the opposition parties.
But it's in
and
the
in those
background,
opposition
so
parties,
you are more than welcome.
the minister in any event presented a 0.5% increase effective 1 May 2025. So the proposal is the VAT going up from 15 to 15 to 15.5%. The transfer duty, some relief there. In the previous financial year, transfer duty on purchasing of residential or any other property from R1 to 1 million. It's now gone up from R1 to 1.2 million. Some relief for middle income earners that still want to buy their first house. And, the transfer duty obviously is a big portion. It'll give them some relief in purchasing, a house to that value. Another relief is smartphones. As you know, the South African public likes smartphones and chicken consumption. With smartphones, I think, the minister has applied his mind again here, and there's a lower value tariff on smartphones coming down to 0. So on certain lower value smartphones, there was a tariff. It's now come down to 0. Social grants, a big talking point, 284 billion allocated to social grants. Again, yeah, some 27 million people in our country is obviously getting these social grants. And, yeah, a big talking point about serving the poor and the elderly. You'll see the old age and disability grant moving from the previous allocation of 2,150 or 2,200 and something to 2,315 into 2025. Child support grant going up to 560 and the foster care grant going up to 70 rand. Sin taxes, yeah, for all our sins every year we've got to pay for the next year. Those that are obviously, consuming the alcohol beverages and other, there's an average of 6.75%. If you, obviously more on the exotic side of tobacco consumption, cigars, pipe tobacco and other 6.75%. And then general cigarettes and other tobacco products across the board, all tobacco content, a proposed increase of 4.75%. Let's have a look at SARS legal and compliance updates. A big ticket item, as you are aware, South Africa 3 years ago was faced with being put into the grey listing status. Naturally, South Africa then got kind of a wake-up call from FATF and was then asked to go and execute what needs to be executed in terms of ensuring that you then come out of the grey listing. South Africa embarked on this particular project 3 years ago. My estimation was July 2025. I still stick by that. And I think, in the first 2 years of the grey listing, South Africa has met the said requirements. And from that, South Africa is now sitting with the last set of requirements, possibly 6 items to meet. This particular action items that's been put forward. It was proposed that the Financial Action Task Force would get a presentation from Treasury in February 2025. That particular presentation is now shifted to March, given the extent the budget that was postponed from last year to this year, and also given that the G20 Finance Minister Summits that was held last week or 2 weeks ago in South Africa. So I think National Treasury is all upbeat in doing the presentation to FATF and ensuring that perhaps maybe, we get the green light from FATF. Remember, you would see that in the last 2.5 years, SARS, Treasury, Financial Intelligence Center, the Financial Services Conduct Authority, CIPC, grinding taxpayers on various disclosure and requirements, so much so, asking you for beneficiaries of trust, who the beneficiaries of the trust, who the beneficiaries of the beneficiaries are, who the beneficiaries of this trust is offshore, and all these compliance requirements to obviously deliver on this particular items that's really kept us back. You would also find a lot of that coming out from the financial services sector, the banks stepping up big time on other disclosure requirements in terms of FICA and compliance, and actually getting to know who exactly is the account holder, what monies are flowing through the account, and how are you accounting for all the transactions. So again, the grey listing is a big item, and should South Africa succeed in its achieving, all of FATF's requirements, again, I say the prediction being July 2025. If we come out of the grey listing, it's been a hard 3-year period. I think, Q3 and Q4 of 2025, being July 2025 to December, the economy may just get a big upswing in terms of a positive spin-off. So, is this a rabbit under the hat? If South Africa does it and, achieves this, then, there's some positives at, the second half of the year. Transfer pricing, As you are aware, the President signed the Global Minimum Tax Act in December, just before Christmas on 24th December, bringing the legislation into the South African context for implementation. Naturally, the global minimum tax is part of the international transfer pricing Pillar 2 framework. And the aim was obviously, the natural BAPs, commonly referred to as base erosion and profit sharing. The global adoption also adopted by approximately 65 countries, and it's based on the OECD Global Minimum Tax Agreement that all 65 countries signed to. Just in summary, the Act imposes a minimum tax of 15% on global multinational corporations whose revenue exceeds some 750 million euros, equated to our domestic currency of about 14.25 billion. The recent withdrawal by the Trump administration, I'm sure you've also seen that an executive order was issued by Trump saying that, American multinationals operating outside America in all these 64 jurisdictions, he simply torn up the agreement and said we're no more party to that. How the balance of the countries deal with this particular withdrawal by the United States is a massive challenge. And, those dynamics will definitely come to fore in the G20 summit this year to be held in South Africa, as well as, leading up to that summit, exactly how does SARS apply this global minimum tax to multinationals or American multinationals operating in South Africa. Here, I've just summarized big ticket items for you as the audience and taxpayers to be aware of what's currently taking place in the last year and what will continue taking place going forward. Section 9H, the exit tax charge for cessation of tax resident. As you know, when a taxpayer wants to exit South Africa and cease his tax resident, the Section 9H tax calculation comes into play. So, South Africa says, we love you, but before you leave, please pay your exit tax charge. And that Section 9H, is more and more scrutinized. Obviously, government is concerned about, more and more taxpayers leaving the country in whichever form or manner, be it normal professional taxpayers, entrepreneurs, or other, as well as, the outflows of monies going abroad. Section 18A, tax deductibility of donations. You would have also seen in 2024 the automation of the certificates that come through on the individual IT12 returns. That's also being beefed up further, and you'll see more focus on that through reviews or audits conducted by SARS. If they're not, sure of the third-party data that's coming through on the population of the tax return, SARS will then ask you naturally for, for you to produce the 18A certificates through a review or audit. Section 12H, learnership programs. Again, a big focus there, just checking that the learnership programs is not being manipulated by employers or taxpayers, specifically how many learnerships you're carrying out, how long have they taken place, have they completed? And, these are the questions that you must be aware of that you will get through. So information, documentation, paperwork around learnerships must be kept readily available should it be subject to audit or investigation. Collective investment schemes. In the budget, you would have also seen a proposal about taxing, revisiting collective investment schemes. And the proposal coming out of the midterm budget policy statement in October was to tax profits in the hands of the investor on a revenue basis. This is a massive, massive talking point. It's actually saying, we're now going to move the responsibility to the investor, and any profits that the investor makes, we're then going to target it on a revenue basis. So that's a proposal. One would then have to see, what Treasury unpacks with this between now and October 2025. SARS e-filing challenges. Currently, we've been flooded with this. I'm aware of a lot of registered representative updates, taxpayer profile merging across tax types, and bank details updates. Is creating a logistical nightmare for all tax practitioners, for everybody that's, constantly on e-filing, updating these changes. SARS simply, on the e-filing system, simply, just not executing it fast enough. Taxpayers are getting frustrated. Public officers are getting frustrated. Text types are not being merged correctly. So, this is also another big challenge that, you should be aware of. And hopefully, the administration around this taking place, gets better into 2025. An update of the latest interpretations notes issued. These are selective ones that SARS have prepared for the last year and going on to this year, and more will flow into 2025. But what I've done here is summarized for you just what is significant coming through on various parts. The first one is Interpretation Note 136, Public Benefit Organizations, Non-Professional Sport and Recreation. There was some interpretation and misunderstandings between taxpayers and SARS around this particular aspect of public benefit organizations. So that interpretation note has been issued. Interpretation Note 105, deductions in respect of buildings used by hotel keepers. Also some clarification there. Interpretation Note 83, tax invoices, debit notes, and credit notes for VAT purposes. Again, there were some contentions between vendors and SARS, so clarity has now come out again. Interpretation Note 74, deduction and recoupment of expenditure on repairs. As you know, repairs and maintenance, a big talking point always. Is it repairs and maintenance? Is it capital in nature? And obviously this, deduction and recoupment of expenditure on repairs. If one looks at Interpretation Note 74, there's some moving parts there that also, again, SARS clarified or given the level of audits that were executed in the last year, where taxpayers disagreed and SARS disagreed. So I think some of the aspects went SARS' way, some went the taxpayers' way, but the Interpretation Note 47 now puts some more context on it. 75, exclusion of certain companies and shares from a group of companies as defined in section 41.1. Yeah, the big contention point around, the definition of group of companies. Am I in, am I out in this group structure? How does my group structure look? And what exactly is, the definition of group of companies as defined? Different interpretations from taxpayers, the large taxpaying community, and SARS. And I think now they've made it very clear in Interpretation Note 75 of what is excluded. 53, limitation of allowances granted to lessors of effective assets. I think this is just something new that's just come out, not necessarily a big focus, but I think, it was due for some time. They just granted some clarity there. Interpretation Note 24, public benefit organizations, partial taxation. Again, public benefit organizations, big focus around, is your PBO doing what it's supposed to do? Did you say what you said when you got the public benefit organization status? And we see some other activities happening in your organization that's not warranting what your actual activity is. So there's a distinction there between public benefit activities in line with what's been set in the public benefit organization's constitution and MOI and all the documents that go with it versus what is actually not public activities. And those activities that are not public activities obviously are subject to tax. So the interpretation note gives you some form of clarification what will be considered and what SARS will look at in terms of partial taxation. Interpretation Note 15, exercise of discretion to extend the period of lodge of an objection and of appeal. We'll touch that on a bit later, but this basically just tells you what the current status of ease with respect to what SARS will allow in terms of the objection and appeal process. There's a new one. It's a draft at the moment. It's Interpretation Note 54, issue number 3, section 23O. Very interesting one. Deductions not allowed for corrupt activities, fines, penalties, and fruitless and wasteful expenditure. I think this particular interpretation note is targeting specifically all the fraud and all the corrupt tenders and everything that we've seen being reported on a daily, weekly, monthly, and yearly basis, in the economy of, taxpayers receiving tenders that were unwarranted or were irregular. Tenders have been questioned. All those processes, the deductions on the expenditure of those tenders where taxpayers claim those expenditure have now come under big time scrutiny. And this interpretation note 54 is going to be a big standing point that SARS will use in the execution of their audits in terms of section 23O in the coming year. Interpretation note 939, paragraph A, the definition of interest in section 24J. About the big talking point last year about interest and the big hoo-ha around interest and those that are involved in, or perhaps maybe you have clients that are involved in section 24J aspects. There's now clarity on, what that definition of interest is that's been brought out, and then the interpretation note 39 just gives you more commentary. This is a very good one in terms of current updates. A recent update coming out of SARB eases foreign exchange regulations. The South African Reserve Bank has introduced significant updates to foreign exchange regulations, streamlining cross-border transactions and reducing administrative burdens for businesses. I think, if any of you are involved in cross-border or your clients are involved in cross-border transactions, you would see that, a big contentious point is when money comes into the country, SARB is very happy. But when money goes out, SARB is not happy. And so would everybody else not be happy. So, outflows on legitimate transactions, SARB have now looked at it and have come out and have eased the burden of ensuring that transactions flow through easily, as opposed to, what was happening previously, where there was just constant blocks from the banks through SARB, saying the transaction is delayed. The financial surveillance team at SARB, asking a lot of questions, and then, you get tied up with 30, 60, and 90 days, just simply not getting payment or whatever the case is. Initially, SARB will not lay down on the transfer pricing regulations. So they've eased the burden of the transactions, but they've maintained that, we want to ensure that transfer pricing regulations are in place. Specifically around payments to non-residents, including associated costs such as traveling expenses, all those things are now permitted, but they eased a bit, but maintaining the principles to ensure there's no manipulation. All right, and then, South Africa entered into a recent double tax treaty in terms of double tax treaty protocols. The latest double tax treaty is with Kuwait. I don't know if some of you are familiar with Kuwait. It's in the Middle East. It's situated next to Iraq. It was famously in the picture during the Iraq-Kuwait war. So that's the country that South Africa has updated or recently put in place a double tax treaty. Yeah, we touched earlier on collective investment schemes. According to the discussion document of the tax treatment published in December 2024, again, there's yesterday, again, another another proposal put into the collective investment schemes is relating to the provisions relating to the asset for share transactions and amalgamation transactions to be reviewed. So like I mentioned earlier on, Treasury will have a look at this between now and possibly midterm budget policy statement in October 2025. It seems to be a big pot of revenue that could be generated from this. And yesterday's budget speech, again brought in an additional item that they're looking at in the CIS, being the asset for share transactions. Section 9H, I touched on it earlier, but here's another new change, proposed new change, targeting, provides that when a foreign company ceases to be a controlled foreign company, the CFC, commonly known as CFCs, it is deemed to have disposed of all its worldwide assets on the date immediately before the date it ceases to be a CFC. So the CFCs has been a big talking point. We will touch later on some decided case law that has occurred in the last fiscal year, and you'll see from that why the focus on the CFCs. Here we see the Section 9D, paragraph 2, cap A of the Act requires that net income of a CFC be calculated as if the CFC were the taxpayer and a resident. The proposal is now that if that CFC is to, obviously exit, then the proposal is to amend and to ensure that the exit charge is triggered on exit, meaning that, they obviously, Treasury's intention is obviously to grab the exit tax charge on immediately when you exit to be a tax resident. This is targeted for PTY's legal entities. On the VAT side, it is proposed that the VAT treatment of the temporary letting of residential properties under Section 18D of the VAT Act and consequent sections of this Act be reviewed and updated. So you would also note that VAT vendors sometimes have taxable supplies, exempt supplies, and zero-rated supplies. And the exempt supplies, specifically in VAT vendors operating in the space where you have letting of residential property. So the Section 18D seems to be, causing some discomfort for Treasury, and obviously this will be updated and reviewed again, and we will see what those changes will be as the months unpack. A good one here. There's been a mobile operator in South Africa that went to court against SARS with regards to the supply of airtime vouchers. And I think, SARS and Treasury had a look at this and seen, what is going on here in terms of airtime vouchers. You will see that the airtime vouchers comprises of two components, namely telecommunication services to be provided outside of South Africa and the distribution services of airtime vouchers inside the country. So mobile operators sell airtime vouchers inside the Republic and outside. The distributors that sell airtime vouchers that can only be used in a foreign country are charging such suppliers at a standard rate. As these vouchers are typically supplied to distributors in South Africa or to foreign residents locally in the country for consumption of telecommunication services, those residents, family members in a foreign country, it is proposed that the VAT Act be amended in this regard. So this dilution of selling airtime vouchers domestically and airtime vouchers across the border or overseas to any recipient outside the Republic, there's a revisit on this, given that court case that has also taken place. And I definitely see that some form of changes will come through in the VAT Act as to, where these gaps are that Treasury has identified and how they will close these gaps specifically in the telecommunications industry. I don't know if you call this a nice one or an easy one or a bit of a relief. The minister slipped in yesterday as well, is to provide an amnesty for customs and excise. Now, you know that the current tax amnesty in place, which is referred to as the voluntary disclosure program, is specifically on the revenue side for all taxes, but it always excluded customs and excise. The proposal now is to have an amnesty for customs and excise. So naturally, Treasury must have done a lot of research to identify a lot of manipulation of customs and excise that is being lost from that revenue pot. And because the voluntary disclosure program works quite well on the revenue side, the proposal is now to have a VDP on the customs and excise side. Let's have a look at the court cases and legal precedents that have come through in the last year. Here we are, the Coronation versus SARS. I mentioned earlier on about the CFCs and the proposed relook at CFCs and the proposals of looking at that section 9, and to close some loopholes. Just an overview, this is a massive case, very significant in nature that took place last year. The dispute centered around Coronation Global Fund Managers. Coronation, quite well known in South Africa. They set up an Irish subsidiary in Ireland, in Dublin. And the first point of entry was that SARS deemed this to be a Section 9D. SARS claimed that Coronation Fund Managers did not qualify for the exemption due to what was happening at Coronation's offices in Ireland. The potential tax liability on the assessment rose about that was raised by SARS was about 800 million, and Coronation said no. Sorry, we believe we are a separate permanent establishment in Ireland. We operate a proper office, we have staff, we operate a proper operation, and we can legitimately say that, we stand by our activities and operations there. SARS disagreed. The matter was fought at the tax court, then eventually got to the High Court, then eventually got to the Supreme Court of Appeal, and ultimately landed up at the doors of the Constitutional Court. On 21 June 2024, the Constitutional Court ruled in favor of Coronation, overturning the Supreme Court of Appeal's decision in favor of SARS. The court held that Coronation's day-to-day operations met the economic substance requirements for the Foreign Business Establishment, commonly referred to as FBE exemption, and it was suitably placed and staffed and conducted its primary fund activities and operations. So yeah, a massive judgment, and I think the next day on the 22nd of October, if my memory serves right, Coronation shares just went up. So if you had any Coronation shares, good luck. You could have made a buck or two there. The Constitutional Court did not comment on the understatement penalty, commonly referred to as USB, naturally because the assessment was overturned. And naturally, if the assessment is overturned, then the understatement penalties follows accordingly. Another important case coming through from the tax court, VAT 1788, key aspects of bona fide inadvertent error. So what you will find is a lot of tax practitioners, accountants, and everybody else saying, oh, you know what, I made a genuine error. And this genuine error was, I declared something on the VAT return in the wrong block. I was in a hurry. I had to go to a funeral. I relied on my staff. All these genuine errors that are generally coming through that SARS is seeing. This particular court case actually goes down to say, what is a genuine bona fide error? And the court's interpretation contrasted with SARS' narrow view of bona fide inadvertent error, as only voluntary typographical mistakes focusing on taxpayers' conduct rather than the error itself. The court affirmed that SARS bears the burden of proof for providing facts for understatement penalties, including establishing the absence of a bona fide inadvertent error. So this particular court case says that SARS must now prove to the vendor that the bona fide error that the vendor made is not genuine. So much so that in yesterday's budget, another proposal that has come through is SARS is now going to issue what they believe is a bona fide inadvertent error and set those guidelines out. And that's purely coming out of this case because it has cost the SARS a lot of money that they've lost on this, and then you still have this court case. So yeah, it's going to be interesting to then see. Don't be surprised, you also get a broader definition of bona fide inadvertent error. A recent landmark judgment coming in the farming sector. Farmers, specifically citrus farmers, that self-insure, take out self-insurance premiums. And this is, to protect their crops and everything that gets affected by their crops, whether it's diseases or infiltration from any other natural sources that affects their crop so much so that they lose production on these crops. And that means that obviously, if they lose production, no generation of income, and they required some form of safety measure. And that safety measure was that they obviously went to self-insure this particular risk that they faced. Now the question comes in, am I then facing this risk, and is it an operational risk against my goods and services? And is the self-insurance premium tax deductible? Now, in this particular court case, the citrus farmer took out self-insurance for 10 million rand, and SARS rejected it. SARS argued that it was a capital in nature, but the court confirmed it mitigated agricultural specific risks. And because it protected the stock or the livelihood of the farming operations of the citrus farmer, it was allowed as a deductible expense, which then means a deductible expense is allowed on the basis that it is going to be, or it is in the production of income. And naturally, the court went in the taxpayer's favor and said, well, this will be overturned. SARS, you're wrong. It does justify the deduction. And yeah, naturally, all other citrus farmers or farmers in the farming industry with a similar type of circumstances as obviously now or will benefit from this deduction. The impact, yeah, for sure, the impact across the whole agricultural and farming sector. All right. We touched earlier on about just reaffirming the tax dispute process. Let's just have a look to refresh your memories if you're not aware, or just a refresher there, a refresher test. As you are aware, original assessment normally comes through upon submission of any taxpayer, individual, corporate, trust, or other. When you submit the original assessment through e-filing, two things happen. First is you get a clean bill of health and you get your IT34 assessment. Or two is you get your IT34 assessment and you get the lovely love letter that says your particular return is subject to verification or review or audit. Once that takes place, naturally the process then flows and there's a letter of completion or letter of audit findings produced. And then you go into step 4 where you get finalization of review or audit or investigation. Upon completion of this 4-step process, if there's an assessment being raised, let's say, for example, in step 4, in the finalization of the audit, and the taxpayer is not happy, you then enter into a first process of objection. That objection was at 80 days and is still at 80 days. It was previously at 60. Last year, it was then changed to 80 days. So you have 80 days from date of assessment to file your objection. After that period, you then have, should your objection be unsuccessful and you're still dissatisfied with the objection outcome, you then have a further 30 days to appeal that decision or introduce or pursue the ADR, commonly referred to as the alternative dispute resolution process. And if all that fails, you still have another cherry to bite on, which then can be referred to the tax board or tax court. Now, in between the objection and appeal process, the commissioner has come out and said that he would like to bring this closer. He would like to sort out disputes quicker and closer as opposed to this longer dragging out period. Because why? Firstly, there's an assessment, there is money, and naturally, taxpayers get calls from debt management to say you owe the money, please pay the money. And taxpayers say, sorry, I'm not paying the money because I've objected. So, what the administrative direction that the commissioner wants to achieve is, let's sort out this dispute quicker. And can we sort out the dispute quicker? And is the taxpayer willing to sort out the dispute quicker? And if so, then, you don't have this long 80, 30, and then going to court. So that is also another efficiency that SARS will drive further into the 2025 year to then see whether, you actually owe this money, or must the assessment be reversed, or what takes place there, or, shall we concede on this and you concede on that, or whatever the case is. But look for the space, because the tax dispute process is huge and there's a huge backlog of cases currently sitting there. So obviously the aim is to deal with all these cases as fast and as quickly as possible, because obviously there's money sitting there to come in or to be reversed out. Good. Thank you so much for your time. And yeah, we can go into Q&A. The floor is open. Please, you're welcome to then pose your questions. And I hope you've enjoyed the presentation of the post-budget summary as best as I could, to give you some valuable insights that will help you go forward into the next year. All right, anything coming through the chat? All right, I see a question there from a participant. If you dispute an outcome, should one pay for penalties and interest? Well, it depends where you are in the dispute process. Remember, you will naturally dispute, you will launch an objection on tax penalties and interest at the same time. You will also in that process ask for suspension of the payment and penalties and interest. Now, the key factor there is you must tick that box on e-filing to suspend the payment for penalties, interest, and tax. If you don't do that, the objection committee only acts on your dispute, while the debt management department will still follow up with you on the collection of the debt until the dispute process is concluded. So, just kind of advise you there, ma'am, just tick the boxes for suspension of payment when you lodge the objection. You must do that. Hope that answers you. Is there any other questions that perhaps Mr. Boyson, you pick up?
Mr. Mayet, thank you very, very much. I see there's one from Nico Serfontein.
Okay.
Okay. Mr. Mayet, thank you very, very much for your insights. We really appreciate it. Thank you for everyone that joined us today. If there's any additional queries. Oh, there is another question. Yes, is the budget finally approved, as the other parties will still object to the proposals?
Yeah, so thank you very much. That's a very important question. So how the process works is South Africa has been used to our democracy for the last 30 years, where the ruling party had the majority being the ANC. And naturally, over the 30-year period, is that when the budget is presented, you then have a vote in parliament. Now, being the majority party over the last 30 years, you will just vote for that, and the proposals and the necessary bills go through, and it gets implemented. For the first time after 30 years, you're now sitting with a government of national unity, which then means that there's other parties within the government of national unity that also needs to vote on this particular bill. And that's what you see taking place yesterday, where other political parties within the GNU and outside the GNU, being the other parties, the EFF and the MK and everybody else, have said no, have rejected. So, that means that obviously it's a proposal. Parliament has now got between now and the 23rd of May to vote on it. And if they don't vote on it, then no, it cannot be implemented, because you need that majority to then pass it. If they vote on it and you get the majority, then naturally it will be implemented.
Excellent. Mr. Mayet, thank you very, very much. We really appreciate your inputs. Wow. It seems like there's a last question. Why did the government not consider a reduction in expenses?
Government expenditure, as you have seen, you're sitting with almost a 2.1 trillion revenue estimation, and you're sitting with about a 2.6 trillion expenditure. That expenditure, I'm afraid, is increasing all the time. And yes, the political will to perhaps maybe, not cut expenditure is a big, big talking point. I think there's a lot of fat there that can be cut off. And if that fat is cut off, you wouldn't need to necessarily increase fat and do all these other things. But yeah, it's a valid question. Government expenditure should be cut. From which date is the VAT increase effective? Proposed date 1 May, but subject to, obviously, the budget being voted and passed on. What will happen if other parties win the votes, meaning the objections go through? Well, if the objections goes through and all the other parties vote against, then you're in deadlock. That means then the GNU will have to find something else as an alternative to then bring back to the National Assembly for tabling, as opposed to the current proposals. That's what will happen. The minister this morning is very confident that the proposals tabled will go through in this consultation process between now and the 23rd of May. Let's see how that goes.
Okay, ladies and gentlemen, thank you once again. I think that concludes today's session. We have run out of time. Thank you very much for everyone's involvement. We really appreciate your time and effort. If there are any additional queries or questions, please feel free to mail Mr. Mayet or anyone address those queries. Thank you for joining us. Have a wonderful day and catch you later. Bye-bye now.